Hey guys, this is Korey Ralston, 5 Star Real Estate. Today I'm going to put together a video for you on escrow accounts and how they can be impactful when you're purchasing a home. I've got an example in here about a scenario where somebody might go from a $1,500 a month escrow payment up to $2,200 without realizing it's coming. So let's talk through it and learn a little bit. So first off, when we get in here and we take a look, you're talking about a new homeowner who's buying a property from somebody who may have owned the property for 2 years or say 20 years. There's going to be a difference in how that hits a new home buyer on their escrow account if they're not careful. So one of the things that you're going to notice is somebody might talk to you about homestead and non-homestead. If homestead means you're living in that house more than half the year and it is your primary home. A non-homestead means it's a secondary property. This could be an investment property, or it could end up being a secondary home where you go and vacation sometimes. So that's a different type of home that you could see as well. Now, in the scenario one here that we're going to look at, let's talk about how a homeowner could be owning the home for 2 years and they go to resell it. In that scenario, if they go and resell the home, their taxes are going to change. So let's say you're the home buyer and you see that the previous homeowner paid $5,000 last year in property taxes. You're looking at the fact that now you're gonna expect something similar. Well, when you get to year 2, it's going to probably change. So let's talk about how that looks. If you're buying a home that was purchased by somebody, and let's say they've owned that home about 2 years and they go to sell it, your escrow account might factor in and be around $1,750 a month, as we're seeing here in these notes. And from there, that's going to include your mortgage, your taxes, and your insurance. And then you're going to see that you've sold it or you purchased it. Let's say that occurs in July. And then in August, the new summer bill comes out and you see that the summer bill is staying roughly the same, still maybe around $3,000 for the summer, and $2,000 comes up around December when the winter bill comes out. So that's all staying pretty similar. So you don't think too much of it. Well, now, year 2, the tax assessor comes out and reassesses the value of the home. That property is now going to see an increase. Let's say that it goes up to $3,500 for the summer and $2,500 for the winter. The annual taxes have gone from $5,000 to $6,000. You, as a home buyer, are used to seeing $1,750 a month come out of your account, and it's still doing the same thing. You may or may not notice any tax assessment bills come to your home, and you're just looking at the fact that you're looking at $1,750 a month. It's still coming out, looks the same, no big deal. Well, year 3, maybe around March, according to experts that I've talked to in our local area, you're going to see that you'll get a notice where the account is short. So now if your escrow account is short, you're going to have to make that up. In addition to that, you're also going to have to be paying the higher increased amount. So now you might get hit with twice the bump. So in year 3, you get a notice, and let's say your payment goes up to $1,915 a month, and you had been budgeting for $1,750. That's a pretty good size increase for somebody who might be on a tighter budget. Now in year 4, you may see that, okay, we've caught up, we've got a little overage, we're going to bring it back down to where it's supposed to be, and you'll stay level at, say, $1,850 a month. So you've taken and ridden this little roller coaster ride of $1,750 on up to $1,920 roughly, and back down to $1,850. And then you're going to stay maybe around that range, depending on your insurance and your taxes and everything going forward. So keep those things in mind. Now, in scenario number 2, we're going to actually have a scenario where the person has lived in the home for, say, 20 years. And what is different here is you can only see an increase of a capped amount each year of your taxable value of your home. So this person in the same home may be paying significantly less in taxes. So if you look at their summer bill, it's, say, $1,400 a month, and their winter bill is maybe around $900 a month, for a grand total of $2,300 per year. Or sorry, not $14,900 per month. That's per tax bill, summer and winter. And then it turns into $2,300 for the year. Now, when you continue to take a look at this, you're going to see that the escrow account might only be $1,500, as you can't budget in overages to your escrow account. So you're looking at $1,500 a month going in there, and then you're going to see that the home closes in the same July type of time frame. Your summer bill comes out, still looks like $1,400. Winter bill comes out, still looks like $900, and your monthly payment's still going through at $1,500, looking fine. Year 2, the tax assessor comes out and reassesses the value of the home. Now they're going to give an increase. Let's say they increase that to $3,500 and $2,500 for the summer and winter, as we discussed with the previous example. So now you're going from roughly $2,300 a month or per year in taxes to $6,000 a year in taxes. So as we continue down, we notice that you're still paying that $1,500 a month in year 2, not aware of the change. Now, you might see paperwork come that tells you that you've been reassessed or something to that aspect, and you might see some sort of other things come across, but you're not going to get much of a call out here. Nobody's going to usually give you a phone call and explain everything to you of what's going on. So as you continue paying that $1,500 a month, because that's what your escrow is pulling, you're falling behind. And so they'll pay those other charges, but then come March of year 3, you're going to get a hello notice where you're behind and have to make up the difference. So now you're going from that $2,300 to $6,000, and you're down, say, $3,700. Now, in addition to that, you're also going to need to increase enough to make $3,700 additional for this next year so that you're not falling behind this next year. So now that payment might go up to, say, around $2,200 from $1,500. That's a pretty significant increase in your budget for your mortgage. Now, in year 4 of the home ownership, you could see it bump back down to $1,850 after they get caught up for that shortage. Some of these different lenders may also offer the option where you can pay off a big chunk of cash at one time to pay off your back amount that you owe on taxes for your escrow account and get it caught up. So bear these things in mind. There can be some surprises when buying a home, and the escrow account over the first couple of years can be the biggest one if you're not careful. So please pay attention to that. Make sure you're homesteading your home if it is supposed to be homesteaded. That'll save you money as well. And there can be some other things that kind of come up along the way. So feel free to talk with your lender, talk with me, talk with whoever your expert is that you'd like to learn some additional info from. Let's try and make sure that this process is smooth, not just when you purchase, but going forward as well. Thank you very much for your time. You guys take care.